The UK housing market has had the worst affordability conditions in 150 years, mortgage rates at a 16-year high, real wages falling, transaction volumes down 20%, and prices barely moved. That's not a sign the market is healthy, that's a sign it's frozen. Frozen markets don't stay frozen. When the pressure builds long enough, and it has been building, something gives, not everywhere. Not all at once, but in specific cities, for specific reasons, the cracks are already showing. This is the story of where and why. UK house prices rose by an average of around 25% between early 2020 and their peak in mid-2022. That is not organic growth driven by rising wages. That is pandemic-era demand, rock-bottom interest rates, and the stamp duty holiday all arriving at exactly the same time, a perfect storm, and it pushed prices to levels that earnings simply could not justify. Then rates went up. The Bank of England base rate went from 0.1% in late 2021 to a 16-year high of 5.25% by August 2023, since cut to 4.25% as of May 2025. But the damage to affordability was already done. The average two-year fixed mortgage rate shot from under 2% in early 2022 to above 6% at its peak. Here is what that looks like in real terms. A £250,000 mortgage at 2% costs around £1,060 a month. At 6%, that same mortgage costs £1,610. That is £6,600 a year extra, just from the rate change. For a lot of people, that is not an adjustment. That is a financial crisis hiding behind a fixed-rate period that has not expired yet. But the market did not crash, and this is where it gets interesting. Sellers locked into low fixed-rate deals simply did not move. Transaction volumes fell around 20% year-on-year at their lowest point, according to HMRC data. But because there was almost nothing available to buy, prices held up far better than the underlying economics would ever suggest they should. Now that freeze is starting to thaw. The FCA estimated that by end of 2024, around 1.6 million mortgage holders had already seen their deals expire and faced significant payment increases. That wave of cost shock filters through slowly as people exhaust savings, cut spending, and eventually face difficult decisions about whether they can afford to stay. UK household savings rates dropped sharply through 2022 and 2023 as people drew on pandemic-era buffers. The ONS tracked a sustained decline in real household disposable income over this period. The national average tells you almost nothing useful. The UK is not one housing market, it is dozens of overlapping local markets, each with its own income levels, employer base, and supply dynamics. Right now, specific cities are showing genuine signs of strain. London is always where people look first, and where people most often miss what is actually happening beneath the headline. London prices overall have been relatively flat to modestly negative in real terms, but that masks enormous variation. The Outer East, Barking and Dagenham, Havering, parts of Bexley saw some of the sharpest pandemic surges as remote workers chased space and relative affordability. Now those same areas are correcting. Some outer London postcodes saw nominal price falls of between 5% and 8% from their peak to late 2024, according to Rightmove and Land Registry data. Central London prime property is insulated. International buyers and cash purchasers are not sensitive to UK mortgage rates. But for the average working Londoner, affordability is at historic lows. The ratio of house prices to earnings in London stands at around 11:1, according to ONS data. In the 1990s, that ratio was closer to 4:1. Think about that for a moment. Aberdeen might genuinely surprise you. Its housing market has been structurally challenged since the oil price crash of 2014 to 2016, which devastated the North Sea sector and the entire local economy. Aberdeen remains one of the very few UK cities where average house prices are materially below where they were 10 years ago. Not in real terms adjusted for inflation, but actually below in cash terms. Rental yields are higher than the UK average, but that reflects suppressed capital values rather than booming demand. It is yield born of weakness, not strength. The lesson from Aberdeen matters more broadly than people realize. Housing markets can stay depressed for years, potentially over a decade, when the economic foundation of a city fundamentally changes and does not recover. People bought in Aberdeen in 2013 at what felt like fair prices with strong local employment. A decade later, they are sitting on nominal losses. Worth keeping in mind when looking at other UK cities now facing structural economic challenges of their own. Manchester is one of the great regional property success stories of the last decade. Media City UK, strong graduate retention, a growing professional services sector, and substantial infrastructure investment all drove remarkable price growth. Manchester house prices roughly doubled between 2013 and 2023, according to Land Registry data. But rapid appreciation always has a ceiling. Zoopla's UK Cities House Price Index has consistently highlighted Manchester as one of the markets where house prices relative to local median earnings moved fastest, meaning buyers priced out of London came here, bought aggressively, and gradually replicated the affordability problem they were originally escaping. There is a dark humor to that if you think about it long enough. New supply is also a significant variable. Manchester city centre has seen enormous build-to-rent and new-build development, particularly in Salford Quays, Ancoats, and Middlewood Locks. A large volume of similar apartments coming to market simultaneously, combined with squeezed buyer affordability, creates exactly the kind of oversupply risk that pressures prices downward, particularly in the new-build flat segment. Research from JLL and Savills has consistently flagged apartment oversupply in the city core as a meaningful risk factor. That does not make Manchester a bad place to invest. It makes certain product types in certain postcodes worth approaching with more caution than the city's overall narrative might suggest. Mortgage stress is not distributed evenly across income levels. It hits the middle hardest, and it does so in a way that takes time to become visible in the data. High earners have savings buffers and often carry small mortgage balances relative to income. The lowest earners are predominantly renters. They feel the pressure through rising rents, not direct mortgage stress. It is the substantial middle group, working homeowners with mortgages in the £200,000 to £450,000 price range, bought relatively recently, that faces the sharpest pressure from rate resets. UK Finance reported that homeowners in mortgage arrears reached around 107,250 in Q3 2024, still below 2008 crisis levels, but the highest since around 2015 and rising meaningfully. Repossessions have not spiked dramatically because lenders are under FCA pressure to attempt forbearance first. Payment holidays, term extensions, interest-only conversions, but arrears today are repossessions in 12 to 18 months if circumstances do not improve. That is the historical pattern, and it is worth watching closely. The southeast commuter belt does not get nearly enough attention in these discussions. Places like Guildford, Reading, Woking, Crawley, and Basingstoke surged during the pandemic as people left London in large numbers. Those price levels only made sense if you assumed two things: that London was permanently unaffordable and that remote working was a lasting structural change. Both assumptions have since been partially revised. Return-to-office mandates changed the commuting calculus substantially. Being over an hour from London on a train became more costly in both time and money. Annual season tickets from many southeast towns cost over £4,000. Combined with elevated mortgage costs, council tax, and energy bills, the affordability equation tightened considerably from where it appeared in 2021. Rightmove data through 2024 showed asking price reductions becoming more common in commuter belt areas than in many regional cities. Properties sitting longer, more price reductions, buyers offering below asking with confidence. These are the quiet signs of a market where buyers have leverage they simply did not have 2 or 3 years ago. Up north, there is a meaningful divergence worth understanding because not every northern city is struggling equally. Leeds, Liverpool, and Newcastle held up better than many analysts expected through the rate rise cycle. These cities benefited from a base of relative affordability that gave buyers more room to absorb rate increases. Where London buyers were stretched to the limit before rates rose, buyers in Leeds or Newcastle had more headroom, and that headroom turned out to matter enormously. Leeds has a strong professional services and legal sector, a large student population feeding rental demand, and price-to-earnings ratios that remain more manageable than many southern equivalents. Nationwide's regional indices showed Yorkshire and the Humber as one of the more resilient regions through 2023 to 2024. Liverpool is more complex. Investor interest historically supported prices in certain postcodes, but sentiment has cooled with higher borrowing costs, the phased removal of mortgage interest tax relief under Section 24, and the incoming Renters' Rights Bill. When investor buyers retreat from a market partly sustained by investment demand, prices in those segments can soften without much warning. That story will continue to develop through 2025 and 2026. What actually causes a housing market to crack, not just wobble, but genuinely decline in a sustained way? The answer is a combination of three things arriving together: rising supply, falling demand, and forced selling. You rarely get all three simultaneously in the UK because planning restrictions constrain supply, cultural attachment to homeownership sustains demand, and lenders try hard to avoid forced selling. But elements of all three are now present in specific local markets, and that is what makes this moment different. Coventry is worth examining specifically. Its significant economic reliance on automotive manufacturing, with Jaguar Land Rover navigating the electrification transition, creates genuine employment risk. JLR employs tens of thousands of people across Coventry and Solihull, directly and through the supply chain. That transition creates a period of real uncertainty that local housing markets absorb through reduced confidence and reduced demand. So what does all of this mean for you? If you are buying and waiting for a dramatic crash, the UK's chronic supply shortage means a 30% to 40% fall is not what the evidence points toward. The OBR, Halifax, Nationwide, and Savills have all modelled corrections in the 5% to 15% range nationally, with steeper falls in overextended local markets. The crash predicted at peak pessimism in late 22 has not materialized, but a genuine real terms correction has. And increasingly, mortgage affordability, not just price levels, is the gating factor. A home cheaper in cash terms but available only at a 4.5% mortgage rate is not necessarily more affordable than it was at 1.8%. Run the numbers on monthly cost, not just asking price. If you are selling in a pressure area, Outer London, the South-East commuter belt, city centre flat markets in Manchester or Birmingham, you have less pricing power than 2 years ago. Time on market is longer, buyers are offering less with greater confidence, and chains are falling apart more frequently as affordability assessments trip up buyers mid-process. Realistic pricing matters more than it has done in a long time. If you are renting, the picture is more painful and harder to see improvement in soon. Average UK private rents rose around 9% in the year to early 2024. Rental supply has been squeezed by landlord exits, driven by the tax and regulatory environment, and by affordability pressures keeping would-be first-time buyers renting longer than they planned. A landlord sells up, the tenant moves, they look for somewhere new and find everything costs 15% to 20% more. There is no soft landing in that scenario. The Renters' Rights Bill will improve some protections, but it does not build a single new home. That is the honest reality. Here is the bigger picture. The UK housing market has structural problems that neither a rate cut nor a planning reform can fix quickly. Supply has been insufficient for decades. The gap between what homes cost and what wages can support has been widening since the mid-1990s. People born in the 1980s and 1990s are homeowners at significantly lower rates at equivalent life stages than their parents were, according to Resolution Foundation research, with long-term social and economic consequences that are only beginning to become clear. The stress visible in specific cities right now, corrections in overextended markets, mortgage arrears rising quietly, landlords exiting, commuter towns repricing, economic uncertainty feeding into confidence, these are not random anomalies. They are symptoms of a system that has been under structural pressure for a long time, finally showing the cracks more visibly under the weight of higher rates and stretched affordability. Understanding which cities are cracking and why is how you make better decisions in a market where the national average tells you almost nothing useful. Stay informed, watch the cities closely, watch the arrears numbers. And if this helped you see the UK housing market even a little differently than before, that is exactly the point.